Call up Brian Nowak to the stage. Brian is Managing Director and Head of U.S. Internet Research at Morgan Stanley. And Brian's going to give us the view from the top. What's going on with the public tech giants and how they're investing in AI. And as a fun fact, when Brian was first here, I think 3 years ago, he gave a really great free stock tip to everyone, which was, this was right after the launch of ChatGPT, and Brian said, to buy the chip companies. So if people were listening and they did that, the chip companies have had a historic run. So thank you, Brian, for that advice. And everyone should pay attention to what he says today. Here, over to you. Thanks, Brian.
Thank you. All right, thank you, Liz. Thanks for that nice intro. It's good to see everybody again. So here we are, year 4 of sort of the Gen AI cycle, and I think I was asked to speak about ROIC. What are we seeing in ROIC? Where are we seeing signal that all this investment is actually going to yield real return? And are there any potential kinks in the line to where maybe there's overinvestment? Is this going to be like broadband of years and years ago, as I'm sure a lot of you remember? We've been studying this era. We've been studying this for a long time. I've been at Morgan Stanley 13 years. I've been a sell-side research analyst 20 years. So we've been studying tech cycles for a long time. This is a chart that we've sort of been analyzing the point of every subsequent tech cycle has an exponentially larger impact on the globe. You have everything from the mini computer to the PC, the desktop, the mobile, now to the data era, which is really now called the Gen AI era, soon to be the space era. But the punchline is, as you have more data that can be analyzed, more users, both enterprise and consumer, that are using products and feeding more data into these technologies, the bottom line is that digitization of the globe has an exponentially larger impact. And we think that's what's going to happen here. And the good news is, in year 4, we're seeing good signal. Before we get to the signal, though, we better see signal, because the Capex dollars are very, very large. These numbers are the annual capital expenditure spent by the 6 largest data center builders just on data center Capex. In 2023, the 6 of them, Amazon, Google, Microsoft, Meta, Oracle, and CoreWeave, they spent about $140 billion. This year, they're going to spend about $760 billion. 3 straight years of 80% Capex growth. And there is no sign of it slowing down. Next year, right now, you can see in 27, we have it up 24%. There's only upward bias to that number. The reality is, as we think about 2027 Capex, the constraints are getting physical. It's actually this question of, can you really get enough electricians and plumbers to build 50% more gigawatts in the next 12 months? Can you really buy up 3 years of forward memory supply? Can you really get enough concrete to build 50% more data centers? So the point is, Cable talked about the $1 trillion and the $1 trillion being a big number. We may have the big 6 companies spending $1 trillion on Capex next year alone. So as a stock analyst, I certainly hope there is ROIC on all this, because if there's not, we're going to have a problem with how to think about these stocks, valuations, cash flow, et cetera. Now, the good news is there is real ROIC. This is one of those common questions we get. What are they burning all this money on? Is this going to all be worth it? Like, what are we doing? So we've done a lot of work at Morgan Stanley sort of thinking about how we think about the first $1 trillion of Gen AI-enabled revenue to come across the globe. There's a lot more detail in the note or in the slide deck if you want it, but I think the punchline is that what we thought and what we've seen is we sort of think that about 2/3 of the first $1 trillion of Gen AI or GPU-enabled revenue is going to be on the consumer side, the last third being on the enterprise side. And we've already sort of seen that. Changing consumer behavior is easier. When you go on Google and the Google algorithms get better, and you buy more items, when you go on Meta and the algorithms are better, when you go on Amazon, you're actually having better matching and you're spending more per basket. When you're buying things through GPT, if the utility of products gets better, people use them. Enterprises do move slower. There are quarterly budgeting cycles. There are data privacy questions. There are data safety questions. There are data readiness questions. Enterprises move slower. So our work that we did last year sort of said, we think the first signal is going to come on the consumer side, and then the enterprise is going to follow. What we've actually seen is we underestimated the consumer piece last year. It came even faster than expected. And the enterprises, while they were slower than expected last year, the last 6 months have been very, very encouraging what we're seeing on the enterprise side. So we'll get there. We do a lot of monthly survey. I apologize for this Rorschach test. If you want the slide deck, just let me know. We do a lot of monthly survey work and scraper work, sort of analyzing consumer behavior and enterprise behavior. Part of one of my jobs is really to sort of think about changes in behavior, and we also study what goes on in behavior. This just sort of shows, not surprising, in the United States, about half of people now are using GPT, a third of people are using Gemini, 20% of people are using Meta AI. Hopefully they'll use it better. Hopefully they'll use it more now that we have the new Meta Muse. And you also do have these smaller agents on the right side, like Amazon Rufus, Walmart Sparky, and Target's shopping assistant. The Target one probably needs a rename. We seem to like to name agents like after dogs. Those seem to go well, Rufus and Sparky. So the punchline here is we are seeing adoption across all these tools in the US on the consumer side. And most importantly, commercial behavior is stepping up. People are not just going on Google Gemini or going on GPT and saying, make me an image of dogs jumping over the moon. Write me a story for a lullaby for a 7-year-old that has to do with pandas. Make me a resume. Write me a recommendation letter, practice interviews. That stuff is interesting, but really what matters is, are you seeing commercial behavior that these companies can monetize with all the Capex? And you are. What you see now on the left-hand side is one example with Google and with Gemini. About 40% of people say, yeah, I'm researching new products. I'm trying to figure out what are the best new earbuds. What are the best running shoes to buy if you have a high-end step? 40% of people are comparing prices. 40% of people are actually shopping. Travel is smaller still on the far right, but that travel is going to come. You're going to have the travel assistant. I think it's going to be one of the biggest unlocks to come in the next, call it 12 months. The world where everyone has a personal travel agent and everyone has an interactive travel itinerary, that's not 2 years away. That should be now. You can actually do it through Priceline's Penny or through the booking agent, and Google has it as well. It seems to be rolled out, because if you think about how we plan travel now, it's still a very terrible experience in my opinion. You should be able to say to these agents, make me an itinerary for 7 days in Hawaii for my wife and 2 kids that involves 3 days of golf, 2 Michelin star restaurants, and I want to stay at a Marriott. It will build a whole interactive itinerary for you that you can then toggle the flights, toggle the hotels. Because Google knows the distance from the hotel to the golf course, they can actually pre-schedule you cars. Because they're connected with the restaurants, they can actually book the restaurant reservations for you. That product has been in labs for over 3 years. That is one we are really just waiting to have sort of debuted, hopefully sooner than later, because travel on that far right is an area that admittedly has gone slower than I thought. You just haven't had the killer product yet, but it's coming. And all that is to say, these apps on the consumer side, these agents, they're not just for informational behavior anymore. They are being used for commercial products, and I think you're going to see a lot more of that to come. With agentic commerce being one of the biggest unlocks that we have done a lot of work on that we're most excited about. I pointed out the idea of shopping for earbuds, but I think that everyone's going to have personal shoppers, not just for grocery or for travel, but for everything. As one example, I'm a big golfer. If I said, I'm looking for a new navy blue pair of Roan golf pants, size 34 waist, and I search for it now through Google and I can't find it, that's a bummer. In the not too distant future, Chrome is going to say, do you want me to look for you every day and let you know if I find it? And I'll be like, yeah, that's sweet. You can actually do that now, by the way. You can go into Gemini and you can set up an agent to look for items for you every day and price compare, and you can do that. I used it over the holidays. I had it price comparing certain toys my kids wanted, and when I found them at certain prices, I bought them. You have to be an early adopter to do that now, But the point is, those products are going to be rolled out across these leading tools sooner than later. And before you know it, we are going to have agentic commerce that's going to digitize people's wallets sooner. And the time in which we have agentic adoption is when we don't have to say the word agentic. It's just when you say, look at this cool thing Chrome did. Look at this cool thing that GPT did. You're going to go on there and you're going to search for a new Lego toy and you can't find it, and you're going to say, man, I wish I could know when it's on sale. And it's just going to say to you, do you want me to do a search for you every day? And you'll be like, whoa, look at that cool thing. So the agentic tools are coming. I use food as one of the big unlocks, and I know there's a high-profile startup here as well in this category. I don't know if they're in the room, but grocery online adoption is the lowest of any category in the United States. We think that unlocking the grocery shopper, the agentic grocery shopper, is going to be one of the biggest TAMs, quote unquote, to really crack through when it comes to consumer spending to come. It's a fun fact. In the United States, while 28 cents of every dollar spent by Americans is online, only 14 cents of dollars spent on grocery and CPG is online. So there is a lot. Looking at it another way, when you look at e-commerce the next 10 years, 65 cents of every incremental dollar that comes online within e-commerce is grocery or CPG. So when you want to know what's the biggest bucket of spend in the consumer wallet that's going to come online the next decade, it is grocery, bar none. And this is where there are real opportunities. Some of it's evolutionary, some of it's revolutionary. This is the example where you're taking a picture of your refrigerator and you say, well, I want to make a steak dinner, steak tacos. What do I need? It'll tell you it knows what you have with machine vision. It'll then tell you what you need. It'll build a grocery basket, and bang, you can immediately have the items you need for a party. It's kind of unique. But the real breakthrough that I'm looking for is the weekly grocery agent that's personalized for you or personalized for your family. When it says on Saturday morning, good morning, Brian, here are the 35 things you and your family order every 8 days. I found a new dip that may go well with your favorite chips. I found a coupon on Topo Chico. I think your birthday's coming up. Do you need me to order more beer? Is there anything else you want for the Monday morning delivery? And I'll be like, no, this is amazing. So that is one of the big unlocks that we are very excited about, that there are multiple companies building out, pairing together your grocery data, the grocery inventory information, not only first party in warehouses, but also third party in a lot of the grocery stores that have partnered with these companies, and then ultimately the logistics to consistently deliver that to people. But this will be a very big unlock. There are multiple companies that I'm happy to talk through that are working on this, but I do think that when I look at the consumer wallet and what is going to really drive digitization of that the next 10 years, grocery is going to be a very big unlock, just given the amount of money that there is. But enterprises do matter, obviously. And it's cool to talk about groceries and earbuds, but we got to also digitize the enterprise. As you know, one of the big unlocks with all these models and all these agents is that we don't just analyze structured data, meaning Word documents, Excel, databases. We also get to analyze all types of data, whether it is video, speech, et cetera. It's the vast majority of global data. And companies now are finally starting to adopt some of these tools. You've had some very good signal over the last 6 months. This chart just shows US labor productivity. One of the big unlocks that we're really looking for is labor productivity is low. Like US labor productivity, I think the bar, I got a little screwed up. I'm sure it's our side. US labor productivity is far below long-term trend. And we think that AI can actually help this a lot. We think you're going to see a lot of productivity unlock with these AI tools as more enterprises adopt them. And that has a lot of profound impact for how we think about GDP growth, how we think about managing inflation, how the Fed thinks about interest rates. Bumps in productivity and what you hear companies yield benefits from adopting these new tools are a very important driver of the global economy the next 10 years. And the good news is you're starting to see signal. If I would have given this presentation in November, it would not have been as rosy, but now we're starting to have some spring. It's spring, flowers are starting to bud. So every quarter we do a lot of tracking with a couple of the models actually, as what percentage of the S&P 500 companies, when they report earnings, which we're in the middle of right now, talk about quantifiable benefits from Gen AI or next generation technologies. As of the last earnings season, the biggest source of adoption we had is information technology. It's probably not surprising. Tech companies are the earliest adopters. Almost half of them are now saying, we are seeing benefits that they are quantifying. And when we say quantifying, they're saying, we are saving $200 million annual run rate. We are seeing a 30% increase in efficiency in customer service. There is a whole litany of ways in which they are seeing quantifiable benefits of these early AI tools. The average, as you can see in the S&P 500, is about 20%. A year ago, that was 7. So we have gone from 7% to over 20 now percent of overall companies saying, yeah, we're actually seeing benefits. And you can see the other industries that are also adopting it fast: financials, industrials, and sort of down the line you go as to which companies are adopting and talking about benefits faster and slower. As someone who works at a financial institution, I can fully say, we are part of that 25% of the financials, just the way in which we are pushing a lot faster to push out more tools, test more tools, try to find to redo my team. I have a team of 11 people. We cover 50 stocks in a bunch of different industries. I'm hoping that 1 year from now I'll be standing up here and I'll say, well, I have 11 people, but I have like 70 agents that are actually like working with us, sort of like helping us put out even more and be more productive with how we're doing this. So watch the financials industry. It's actually the fastest growing quarter over quarter bump that we've seen the last 2 quarters of financial companies getting on these conference calls and saying, yeah, we're adopting this stuff and the business models are changing. This just sort of brings up the specifics on what they're doing, but I'll leave that aside. The reason why I think we're seeing that is because we're actually in an inflection year right now when you look at historical enterprise technology adoption curves. So what this shows is this is how you look at a typical enterprise adoption curve. In this case, we look at Office 365 and then one other historical adoption curve as a precedent. You look at year 1 to 2, what percentage of workloads at companies are typically adopting new technologies? 1%. It's that early beta. It's that early test case. Does it actually work? Year 1 to year 2 actually isn't typically that big of a bump either. Enterprises move slowly. Remember, they're budget-based. You go from 1 to 3%. But then year 3, which for most companies right now, we are either in year 3 of this or we're starting year 4 of this. Year 2 to 3 and year 3 to 4 are typically big years of incremental adoption. That's the year when you go from 2 to 3% of our workloads or 2 to 3% of our employees testing the new products to 10% saying 1 in 10, go use this product. It's more productive, scale it up. And then in the next year, you double it again. And so the way in which we're seeing this sort of uptick in companies adopting these tools on the enterprise side in the last 6 months is somewhat consistent with what we've seen with prior cycles, where year 3 and year 4, so that's this year and next year for most enterprises, I think is going to be very exciting for any of your companies that are addressing enterprises. I think there's going to be a lot more experimentation, a lot more scaling up of experimentation, and a lot more willingness to say we are going to press on adopting technologies, the extent to which they work. Because this is the period where if you don't adopt the new technology and your competitors are, you run the risk of falling behind. And we're seeing it in some of the big companies that I cover as well. The enterprise adoption, we start thinking, what are the publicly reported numbers? They're some of the leading indicators of enterprise adoption. It's hyperscale growth. How quickly are AWS, Azure, and GCP growing? You look at the calendar, these are calendarized growth. Look at the 26 estimates. GCP is one of the ones that really stands out. The last 2 years, it's grown 37 to 40%. This year, we think it's going to grow 70. Could be better. We'll find out tonight. Azure, we think it's also going to sort of grow in the mid to high 30s this year. We'll find out tonight. And you can also see AWS, which has accelerated nicely to high 20s growth, could even be better. But I do think that when you think about enterprise adoption and broadening this whole tech diffusion idea of the economy adopting more of these tools, what we see from these hyperscalers, given they are sort of the enabler of these technologies and the railroad tracks of these technologies, is a leading indicator of what's to come. The other leading indicator are the backlogs. These backlogs for AWS and GCP, this is the forward bookings or forward billings that they have recorded, about half of which is going to be recognized over the next 2 years. They report these numbers. You look at 2023, AWS had about $155 billion backlog, GCP's was over $75 billion. Look what's happened now. We think right now, and it'll probably go up tonight, they all report earnings tonight, that's why I keep saying that. It'll probably go up tonight. AWS is about $350 billion of business to be booked, half of which is going to come the next 2 years, and GCP is going to be over $300 billion. If Azure was on here, it's the same. These are forward bookings being made by enterprises and small and medium-sized businesses of commitments to spend on these hyperscalers as a further leading indicator of adoption and diffusion across the economy to come. So if you're wondering, are we seeing ROIC? Are we at the appropriate point in this cycle? The answer is yes. I mean, the consumer pieces are getting more and more commercial behavior. You're going to have a lot of products that are going to be shipped that'll even further digitize consumers' wallets, watch grocery and travel. And then on the enterprise side, the constraint, that's the last one, the red, yeah. The constraint to growth, it's not demand, it's supply. Like GCP, I know I have it at 70. It could grow 90 this year if they had the gigawatts. Like the constraint to all these companies' growth is getting the gigawatt supply and getting the capacity online. So all of these companies have so much demand from enterprises that they are going to keep spending. Capex probably will go to $1 trillion next year if they can find a way to do it, because the constraint to growth, it is not demand. Demand is very strong. The constraint is supply. And so the bottom line is Capex is going to go higher, so I still like the chip companies. And then the overall signal on consumer enterprise is also very encouraging. That's it. Thank you, everybody.